Hello, welcome back. In this video we are taking a look at AMD, Advanced Micro Devices, a semiconductors company that is obviously a target for many people. A lot of people actually want to add this to their portfolio. And I don't doubt that this is a good idea to have this company in your portfolio, but the question is it actually a good purchase right now at its current price? It's been down about 35% the last year pretty much, but it has been trending higher in the recent month. Now if we take a look at the 5-year chart, you will see that although it has been trending a little bit higher in the last month, overall it has been going down since like a year or so, with the rest of the market pretty much. You will see here that the P ratio of the company and the price to free cash flow ratio of the company are rather high, about 40 and 57 here, 57.4. This points to the company potentially being overvalued, but these values enough are not alone to determine what's the actual price to pay for the company. We will do that a little bit later. But you will see another thing here since March 2022. Actually, if you go back to 2017, you will see that the outstanding shares count of the company has been increased about 46%. And of course, this is a pretty important increase. We don't want companies to be diluting us, and it looks like the company keeps diluting shareholders even as we are entering a phase where the stock is going lower. They are still diluting shareholders, it looks like. Now, they have announced that they are going to be buying back shares. I was looking at an article about this one. Let me actually bring it up. So you will see that here in February 24, 2022, they have announced that they will be actually buying back about 8 billion in shares pretty much. And the company has already repurchased approximately 3 billion of shares pretty much. And if we go back to our tool here, you can kind of see what that means, like 88 billion. When the market cap is about 184 billion here, 8 billion is probably going to be about 4 to 5% of their total market cap is what they are buying back. Which is of course better than nothing, but still it's much less than the outstanding shares that they have issued through the years. And also it may be slightly expensive to buy this now, or potentially even very expensive. We will see that. We will take a look a little bit later whether that's the case or not. But total liabilities to free cash flow, the company has a lot of free cash flow when you actually compare it to the total liabilities that they have. That's a good thing, of course. And another great thing about this company is that pretty much the growth has been amazing, from revenue to net income, free cash flow, and total equity. Of course, this has a lot to do with outstanding shares. But overall, it looks like they are getting some tremendous growth here. Now, the debt that the company has is rather low compared to the equity, and the margins and returns are not bad at all. It's 18%, also almost 18% in terms of return on equity. And the net income margins have been a little bit suppressed lately. It's something worthwhile to see, although overall they have been increasing, as you'll see. Okay, so let's determine exactly what is happening here in terms of the financial statements. 5 billion to 16 billion, this is a threefold increase, which is very nice to see from the company. And the net income used to be negative back in 2017. Now it's in positive territory, 3.2 almost billion. Really nice from the company, increasing its net income substantially through the years. In terms of the balance sheet here, this is interesting. You will notice that the total liabilities of the company are sitting at almost 5 billion. That's not a lot. That's definitely not a lot at all, especially when we compare it to the free cash flow, which we will see later. Remember, it is 5 billion here. And the total equity is sitting at 7.5, but you have to also bear in mind that the company has been getting a lot of additional paid-in capital through this issuance of stock that they have been doing. They have been pretty much issuing shares year after year. So they did get a lot of capital because of new stockholders actually buying the stock. Now remember, total liabilities were 5 billion. That is everything that the company owes, from debt to suppliers, pretty much everything. And if you take a look at the free cash flow, is 3.22 billion, and this is where this let me find it here. This is what this means, 1.5. It's about two times free cash flow, the total liabilities. So 5 billion means that if we go back to our cash flow statement here, we have about 50% of our free cash flow that would cover the total liabilities of the company, a little bit more than 50% actually. But you will see that the company is very solvent. It can take them less than 2 years to pay back all their total liabilities if they really wanted to, which means that they don't have a lot of debt, and they won't be having trouble actually paying any suppliers or paying any debt back anytime soon. And this is great to see from a company. You want companies that do not have large amounts of debt, of course, that are not easy to serve. So let's take a look at the stock evaluation tool now and see what kind of price to pay. What kind of stock price to pay for this company makes sense is the question that we are attempting to answer here. Now, the revenue growth of the company has been great through the years, and especially the last couple of years. We can't go that high. We will still go high, 2022 and 24, because the company seems to be achieving that for the most part, although 2019 wasn't the greatest year. Now, this is very high revenue growth, so remember this one. Ideally, we probably want to go even less. But let's just try this one. And of course, if you get access to the tool, you can get access to the tool by becoming a Patreon. You can find links in the description box below this video if you're interested. But you can try all sorts of estimates on your own, whatever you like. Now, the net income margins lately have been at about 20%, 20 to 25. I'm going to go slightly less, 18, 20, and let's say 23. Oops, 24. So, and the free cash flow margin, about 100% here, 80%. This is the odd one out. So 80, 90, and 100, 13% for annual return. Remember, this 100% it basically means that the free cash flow margin is the same as the net income margin. It's 23% is what we're saying here. 100% of the net income margin is what it means. And if we hit calculate, you will see here that our current price is sitting at $106. And even our high estimates here with 4% revenue growth, which is pretty high, of course, as you can imagine, we are still a little bit far from the current price. Not too far, but rather far. And our medium estimates are even worse here, with a 20% net income margin and 22% revenue growth. So it looks like the company is a little bit overpriced yet, in terms of the stock price, that is. It's doing well, and it seems to be doing better and better, but what we originally saw here in terms of the ARP ratio, price to free cash flow ratio, seems to be checking out. Seems to be that the company is still rather elevated in terms of valuation. It seems to be expensive, and also the fact that they have printed more shares is also a burden. And yeah, they may not be stopping anytime soon, although they are buying back some shares. That's a good thing, at least. So that's what I wanted to talk about in terms of AMD, another interesting company. Do leave a comment below and let me know what you think about this company. I'd love to hear from you. And remember to like the video, that helps a lot, and subscribe too, because we'd love to have you around. I'm making tons of videos pretty much every week and every day for the most part. So thank you for watching this one. I hope you are gonna be having an awesome Saturday and an awesome Sunday, awesome weekend, and I'll see you soon, guys. Bye bye.